Hi guys, I'm back with yet another question on investment appraisal from your AFM exam kit. This is also a past exam question and not a very difficult one, but if you practice it right, then I'm sure it will help you in improving your understanding of your AFM exam syllabus. Investment appraisal is a compulsory topic as far as the AFM exam is concerned, so practicing more questions is only going to help you fare better. Now, here the question is, evaluate the financial acceptability of the project Kai investment proposal based on the chief engineer's forecast, assuming regulatory approval is granted in 1 year's time. Calculate the expected net present value of the proposal based on the finance director's assumptions about the likelihood of a recession and the potential impact on project Kai's cash flows. Calculate the net present value of the finance director's alternative option for the technology and advise the board whether this is worth pursuing. And recommend whether the board should proceed with the application for regulatory approval after taking into consideration Hathaway Company's 70% approval rate with its regulatory applications, or to sell the concept now to GEP company. Include in your analysis any comment on your findings. And then, of course, there's a theory part which talks about capital investment monitoring system and post-completion audits. Now, Hathaway Company operates in the aviation industry, manufacturing safety equipment for commercial aircraft. The company has a policy of carefully appraising new investment opportunities, including the detailed analysis of all cost and revenue assumptions prior to their approval. Hathaway Company's board is reviewing a potential investment project Kai. The company's engineers have developed a new technology which can detect the potential for mechanical failure with a greater degree of accuracy than has previously been the case. Early test results have been extremely encouraging. If the board accepts the engineer's proposal, Hathaway Company would need to submit an application to the relevant regulatory authority. It is expected that regulatory approval would be granted in 1 year's time, not right now. Manufacturing and sales would commence immediately after being granted regulatory approval. Hathaway Company's chief engineer presented an investment case for Project Kai to the board, including a summary of the following cost and revenue forecast and assumption. ठीक है. Hathaway Company is expected to sell 3,000 units in the first year of production, with demand increasing by 5% in each subsequent year of its 4-year life. These sales forecasts are based on a contribution of 5,000 per unit in the first year of production and increasing at 2% in subsequent years. Annual fixed costs of 8.7 million are expected in the first year of production, increasing at 3% per year throughout the life. Now, basically, they have given you an year-on-year projection of how exactly is the sales price, number of units sold, fixed cost, how are each of these items going to change. Okay, so you have information on that. Now, one very interesting aspect of this proposal is, see, the regulatory approval is expected in 1 year's time. So if you are standing at T0, the regulatory approval you will get at T1, and then you will start the production. So because of that, the first cash flow will come in at T2, as in after that sales will happen, and we assume that cash flows occur at the end of the year. So if you start the project, if you make the initial investment at T1, then an entire year will go by, and at the end of that year you will get your first cash flow. So this is T2, T3, T4, T5. This is how your cash flows are going to be structured. The timing of cash flows is different, or you usually don't have this kind of a situation. Okay, investment in plant and machinery of 12 million will be required as soon as regulatory approval has been granted. So cash outflow will happen at T1. How much? 12 million. Tax allowable depreciation is available on the plant and machinery at an annual rate of 20% on a straight line basis. Okay, a balancing adjustment is expected at the end of the project when the machinery will be scrapped. Great. Tax is payable at 20% in the year in which profits are made, and the relevant cost of capital to be used is 12%. Okay, now this is Chief Engineer's proposal for Project Kai. And the first part is where you have to calculate whether the project is acceptable on the basis of information given by the Chief Engineer. Okay, so let's plan our answer accordingly. Let's calculate our net present value. For that, we'll need all the cash flows. We know the timing of cash flows. We know the discounting factor to be used. All we have to do is we have to now calculate the amount of cash flow year on year, and that should be our answer. So the first working note that always make, a list of working notes or calculations that you have to make. It helps you to plan your answer better and you don't miss out on anything. Hathaway company has to sell 3,000 units in the first year of production, and sales forecasts are based on a contribution. So straight away they have given you contribution, nothing on sales and a variable cost. Then they have given you annual fixed cost. So these are the two cash flows that you will have to calculate. Then of course there is a tax allowable depreciation that you have to consider. So let's get back to that calculation. Can start it somewhere here, maybe. Working notes. Working note 1, calculation of contribution. So particulars, and here it will be year 2, year 3, year 4, year 5. Okay, that's the one thing that is different in this question. Year 2, year 3, year 4, and year 5. And you know that cash flows are always assumed to occur at the end of the year. So be careful on that front. Okay. A, B. Okay. Let's get the number of units sold in place. How many units did we sell? Check karo, 3,000 units in the first year of production, with demand increasing by 5% in each subsequent year over its 4-year life. So we start with 3,000 and then it's 3,000 plus 4%. Plus 4 plus 4. Okay. Then contribution per unit. But this would be without inflation. How much is the contribution per unit without inflation? 5,000 each year and increasing at 2% in subsequent years. 5,000 in the first year of production. Okay. Or, we could just skip this step altogether and simply just write contribution. It's necessary. Some of you will need that additional. So let's just check whether they have mentioned inflation or not. No, it's increasing. They haven't really mentioned the word inflation. So let's not be over smart here. Let's simply follow the instructions that are given. This plus 2%. So I'll get my total contribution, which will be A into B. 3,000 into 5,000. And I have my answer. If you need your answer in thousands, so this is how you're going to calculate the contribution year on year. Okay. Then what else do you have? You have fixed costs of 8.7 million in the first year of production, increasing at 3% throughout the life of the project. So that's again a simple calculation here. Calculation of fixed cost. Working note 2. How much is it in year 1? 8.7 million. Upon 1,000. Increasing by what percent? Increasing by 3%. So this plus 3%. Okay. So now you have your fixed cost as well. Working note 3 is tax allowable depreciation. You should, when you are reading the question at that point itself, you should make a list of all the working notes that you are going to prepare. It helps you to plan the answer better. 12 million and 20% on a straight line basis. Balancing adjustment is required at the end of the project when the plant and machinery is scrapped. Okay, so what is the cost of the asset? Let me increase the magnification for you. Cost of the asset is 12 million. So SLM depreciation per annum at the rate of 20%. Okay. Now project has a life of 4 years. So WDV at the end of 4-year life will be 12,000 minus 2,400 into 4, which again gives you 2,400. Okay. And then what they have said is that a balancing adjustment is expected at the end of the project when the plant and machinery will be scrapped. Okay. So 2,400 is left and now this will be scrapped. They haven't given us the scrap value. So loss on disposal will be 2,400. There is no scrap value. Okay. Now let's proceed to the statement of NPV. Okay. Calculation of net present value. T0, T1, T2, T3, T4. It's a 4-year project. And of also tax is paid in the same year in which the income is earned. That they have specifically told you. Okay, let's talk about initial investment. कितना हो जाएगा? Minus 12,000. This will happen at T1, which is, when the regulatory approval is given to you. So be careful about the timing of cash flow here. Other parts are not really difficult. Contribution is working note 1. T2, T3, T4, and T5. Okay. From contribution, you will then subtract the amount of depreciation to arrive at profit. Also, there are fixed costs. Okay. So fixed cost, working note 2. Then tax allowable depreciation. How much is that? Tax allowable depreciation is working note 3. And then there is a loss on disposal as well that will happen at the end of the project life. Okay. How much is the fixed cost? You have calculated that here. Just paste it. Okay. Then tax allowable depreciation 2,400 each year. So 4 years of project life, you will have depreciation of 2,400. And when the project ends 4 years after it has started, you will dispose of the machine, zero scrap value. So WDV was 2,400. There will be a loss on disposal here as well. What do you get after this? You get taxable profit. Okay. So taxable profit is how much? It is B, that is contribution minus fixed cost minus tax allowable depreciation minus loss on disposal. Okay. So I have my profit figures for each of the years. How much is my taxable profit? My taxable profit is this. Realized I made a mistake, which is why, reading the question twice is so important. You see, I did, instead of a 5% increase, I calculated my units sold in an incorrect manner. This should have been 5%. That is entirely my mistake, and I apologize. So yes, the unit sold, that increases by 5%. By mistake, I had taken it 4%. So that is, of course, one place where I will end up losing marks if I do that. Also remember that ACCA, if you make this mistake, they will deduct your mark just once. Okay, they will not deduct it here at while calculating contribution, then again in the figure of taxable profit. No, all the marks that they have to deduct, they will deduct in one step only, or at one step only. And later on, if conceptually your remaining calculations are correct, you will get due credit for that. Now, tax at the rate of how much? Again, let's not get ahead of ourselves. Let's see the rate that they have mentioned. Tax at the rate of 20%. 1 upon 1 plus 20% raised to 0, raised to 1, raised to 2. Oh, sorry, what am I doing? Something is just off. What is tax? I calculated the discounting factor. Tax is what? Tax is this into 20%. I don't know. I really need to be careful. Don't make these mistakes in the exam. I'm not going to be one of those who say, oh, I was just trying to check whether you were paying attention or not. I think I was not paying attention. And if I can do that, it can happen to anyone. So be very, very careful. So now I have my profit after tax. How much is my profit after tax? F minus G. But I don't need profit after tax. I need my cash flow. Okay. So operating cash flow will be profit after tax plus tax allowable depreciation plus the loss on disposal, all the non-operating, non-cash expenses you are adding back. Okay. Now let's get our total cash flows in place. Total cash flows, A, which is initial investment, plus I. Okay. Discounting factor at the rate of 12%. That is what we are supposed to use. 1 upon 1 plus 12% raised to 1. I have my present value. How do I get my present value? J into K. So total cash flows into discounting factor. $7027.23. The most important point here is the timing of cash flow, and you cannot afford to get that wrong. So just be super careful on that front. Okay. Now, calculate the expected net present value of the proposal based on the finance director's assumptions about the likelihood of a recession and the potential impact on Project Kai's cash flows. Now, something from the finance director is given in this part. The finance director raised the following objections and consequences to the chief engineer's presentation. The chief engineer's cost and revenue assumptions ignore the possibility of a recession, which has a 20% probability. In a recession, the total present values for the 4 year of production are likely to be 40% lower. Okay, the finance director also believes there is an alternative, mutually exclusive development opportunity based on the new technology, although this would still depend on it being granted regulatory approval. This alternative option would incur an identical investment of 12 million but generate annual inflation but generate annual inflation adjusted post-tax cash flows of 343 million over its 7-year life from year 2 onwards. The chief investment assumes regulatory approval is certain, whereas historically only 70% of Hathaway companies' applications have been approved. By the way, for this part where they want you to calculate the expected NPV based on the finance director's assumptions about the likelihood of a recession, they are saying that there is a 20% probability that a recession will take place and the NPV is likely to be 40% lower. Okay, they are saying that there is a 20% probability that a recession will take place and the NPV in that case will be 40% lower. Okay, so this is part A2. They want expected value. Expected value is outcome into probability of outcome. Okay. So there is no recession and there is recession. These are the two events that are possible. Okay. Now here you have NPV. The NPV is going to be 40% lower if there is a recession. Okay, so I will call this outcome. If there is no recession, then the NPV is 7027.23. But are you supposed to calculate NPV? Please pay attention to the words. The total present values for the 4 years of production are likely to be 40% lower. They haven't said NPV is going to be 40% lower. They are saying the total present value of 4 years of production are likely to be 40% lower. So I should write down present value of cash flows, and they have mentioned 4 years of production, which will be T2 to T5. है ना? They are not talking about NPV. Okay, be careful. 17,742 is the present value of cash flows when there is no recession. Okay, and if there is recession, this is going to be 40% lower, 10,645. Okay, what is the probability? Probability of occurrence. There is a 20% chance that there will be a recession. That means there is an 80% chance that there will be no recession. Okay, and expected value will be outcome into probability of outcome. 16,322 is the present value of, is the expected present value of cash flows. Okay, now this is basically the number that you were trying to calculate. What have they asked? They have asked expected net present value of the proposal. So now expected NPV is PV of inflows minus PV of outflows. Expected NPV 16,322 minus initial investment. How much was the initial investment? 12,000 was the initial investment. So minus 12,000. This is your expected NPV in case 2. Let's now look at part 3. Calculate the NPV of the finance director's alternative option for the technology and advise the board whether this is worth pursuing. What he is saying is that there will be post-tax cash flow of 3.43 million over its 7-year life. Okay, so part A 3. Okay, particulars, and now you have, see, initial investment occurs at T1, then T2, T3, T4, T5, T6, T7 and T8. I have my initial investment occurring at T1 because regulatory approval will be given then. So minus 12 and then post-tax cash flow, which is 3.43. Then total cash flow, discounting factor at the rate of, I think it's the same 12% discounting factor, raised to 6, raised to 7, raised to 8. Okay. So now you have all the data on cash flows. Get the present value by multiplying the cash flow with the discounting factor. So net present value is PV of inflow minus PV of outflow. Since this NPV is a positive number, the project is worth pursuing. Okay, that's your conclusion. Now, recommend whether the board should proceed with the application for regulatory approval after taking into consideration Hathaway Company's 70% approval rate with its regulatory applications, or to sell the concept now to GEP Company. Include in your analysis any comment on your findings. Okay, now if the board does not reject the proposal now and the project goes ahead, okay, what happens? If you don't get an approval, there will be a scenario, and then there will be a scenario, where you do get an approval, right? What are they asking you? They are asking you, recommend whether the board should proceed with the application for regulatory approval. Should you make an application to the authorities? Okay, if you don't make an application to if you make an application and the application gets approved, okay, then of course there will be certain cash flows that occur over the life of the project. And if you make an approve, if you don't even proceed with that idea and you sell the project today, you sell the concept today to GEP Company, you will get 1.0 million. If the board rejects the proposal now, assume that the concept can be sold for 4.3 million immediately. Okay, regulatory approval is certain where historically, see, this person assumes that regulatory approval you will get, but historically only 70% of the applications have been approved. In 1 year's time, if the regulatory application is not approved, it is assumed that the concept can be sold to GEP Company. So making a bit of a decision tree here, I think will help our case. Okay, so this is my starting point. Okay. So at this point, I have to decide whether I should even go ahead with making that application. Okay, so let's understand. So outcome one would be board rejects the application. Outcome two would be board decides to proceed with the application. Board rejects the application now. Okay. Or second thing would be board accepts the application, or board rejects the proposal. Instead of saying application, let's use the word proposal. Board rejects the proposal. Board accepts the proposal and proceeds with application. Okay. Now, if board accepts the proposal and proceeds with application, then you could either get a regulatory approval or you would end up not getting the regulatory approval, right? So there are two: approval is given or approval is not given, basically. Approval is received. Option two, approval is not received. Two scenarios. Okay. If the approval is received, what will happen? If the approval is received, then naturally the company will get the cash flows that it has, that it has signed up for, basically. On the other hand, if the approval is not received, the project can be sold to GEP company. Okay. Again, come back here. The investment case assumes regulatory approval is certain, whereas historically only 70% of the applications have been approved. In 1 year's time, if the application is not approved, it is assumed that the concept can be sold to GEP company for 1 million at that time. Probability of not getting the approval is 30%. And if that happens, the project can be sold to GEP company at 1 million. Okay. What is the probability of getting the approval? Probability of getting the approval is 70%. Okay. And then what is the value that you will get? Let's find that out. Okay. So what happens when you get the approval? How much NPV will come your way? You will get an NP. So that is the next part that you have to calculate. Okay. The NPV that will come your way, provided you proceed with the finance director's proposal, right? Let's calculate that part. This question in many, many ways, can become a lesson in what mistakes to avoid. Another mistake that happened, or another mistake that I deliberately did here was, see here, I'm writing expected NPVs, PV of inflow minus PV of outflow, and I'm subtracting 12,000, which is again incorrect. Why is that incorrect? Because this outflow happened at T1. And when the outflow happened at T1, that means the present value is 10,714. Again, another place where I have to be super careful, right? So if you make one mistake, if you don't pay attention to one aspect of the calculation, a lot can go for toss, right? So be very, very careful in terms of how you are collating the data, from where you are picking up the numbers. If you do this, how much is the NPV? NPV, if you go ahead with the finance director's proposal, is 5.61 million. Okay. If that is the case, then what is the expected NPV? 5.61 into 70% plus 1 into 30%. Okay. How much does that give you? That gives me 4.19 million. But again, another important point. What is that point? This 1 million you will receive 1 year from now. Okay. So into discounting factor at the rate of 12% for T1, right? So expected NPV is going to be how much? Expected NPV is 4.19. Be very, very careful. Huh? This question you will lose marks for, not for any other conceptual issue, but for one simple reason, that you did not pay attention to the timing of the cash flows. So that is very, very important. If the board rejects the proposal now, the project can be sold at 4.3 million. Now, what will you prefer? 4.3 million here and 4.19 million here, you would, if the board rejects the proposal today, you would be in a better off position. So that is the alternative that you should go for. Again, guys, a question that does not have anything different from a conceptual standpoint. Okay, there are no complicated adjustments, there are no uh, not a lot of complex information is given to you, but the timing of cash flows, if you don't get that right, you will end up losing marks in the question. So be very, very careful in terms of the timing of cash flows. Don't make any mistake there. Take 2 minutes more, but make sure that you do it properly.